Imagine checking your news feed and seeing a headline that feels impossible. The Standard & Poor's 500 index is trading near record highs, suggesting the economy is booming and investors are confident. Yet, the same day, consumer sentiment hits an all-time low, indicating that everyday people feel terrified about their financial future. This is the worst disconnect ever. It creates a confusing environment where the market signals one thing and the people signals one thing and the people signals another. You might feel like you are missing something, or that the entire system is rigged against you. This is exactly where most investors make the biggest mistakes of their lives. They try to make sense of the noise instead of sticking to a plan that works regardless of the noise. Here is the thing about this market environment. It is not driven by the average person. The stock market is largely driven by institutional liquidity and the performance of a few massive technology companies. When these giants rise, the index goes up, even if the average person is struggling. This creates a fragility where retail sentiment acts as a lagging indicator of structural stress. You are looking at two different realities at the same time. The market is pricing in future growth and institutional wealth, while the consumers are reacting to current costs and economic anxiety. This divergence is dangerous because it relies on a wealth effect that becomes unsustainable when sentiment hits those all-time lows. Now consider how your brain reacts to this. Human beings are wired to look for patterns and threats. When you see prices going up while everyone around you is panicking, your brain screams that you are being left behind. You feel the urge to sell to lock in gains or buy the dip because you think the bottom is near. This is where behavioral finance comes into play. Research into sentiment feedback in equity markets suggests that positive sentiment shocks generate more persistent returns than negative ones. This means that when people are happy, the market tends to stay high longer than expected. Conversely, when people are scared, the market might stay low longer than logic suggests. This asymmetry is driven by retail investor heterogeneity and structural constraints that prevent prices from correcting immediately. There are technical terms for this, like push-response anomalies and high-frequency price series. This means that extreme sentiment divergence triggers non-linear volatility spikes. In simpler terms, the market does not move in a straight line. It spikes and crashes based on emotional reactions rather than pure data. Machine learning models trained on historical data, including Bert-based sentiment analysis during crises, predict that such extreme divergences often precede sharp corrections. The market is relying on consumption fueled by asset prices, but when confidence collapses, that cycle breaks. However, knowing this does not help you time the market. In fact, trying to time the market during these periods is the fastest way to lose money. This brings us to the strategy. The actionable takeaway for investors is to monitor the correlation between retail sentiment indices and market volatility, often measured using GARCH models which forecast future volatility based on past patterns. But you do not need to run these models yourself. You need to recognize that the current worst disconnect ever historically serves as a leading signal for a potential mean reversion in equity prices. This means the prices will eventually catch up to the economic reality. The question is not if it will happen, but when. And you cannot know when. Therefore, the best strategy for beginners is to ignore the noise and stick to automated contribution schedules. This is a behavioral finance strategy that removes the emotion from the equation. When you automate your contributions, you buy more shares when prices are low and fewer shares when prices are high. This is known as dollar-cost averaging. It forces you to buy when others are fearful and sell when others are greedy, without you having to make a conscious decision. It turns the market disconnect into a benefit for you rather than a source of stress. Think of it like planting a garden during a storm. You do not stop watering the plants because the sky is dark. You continue the routine because you know the sun will come back. The market is the same. The history of initial public offering returns suggests that a prolonged period of high stock prices coupled with low consumer confidence typically signals a tightening of capital markets. This means new listings will slow down and investor risk appetite will shift from growth speculation to capital preservation. If you are already invested, you are in the capital preservation phase. If you are waiting for a sign to enter, the automated schedule provides that sign every month. You might worry that you are throwing money into a sinking ship. But the research on sentiment and volatility indicates that traditional statistical models fail to capture the asymmetry of current market dynamics. Relying on gut feelings or news headlines is like trying to navigate a ship using only the weather report instead of a compass. The compass is your investment plan. The weather report is the news. The weather report changes every hour. The compass points north. You do not change direction because the wind is blowing hard. You adjust your sails, but you keep your course. This approach protects you from the push-response anomalies that trip up individual traders. When the market spikes due to sentiment shocks, you do not chase the high. When it drops due to fear, you do not panic sell. You simply execute the schedule you set up when you are calm. This discipline is what separates successful long-term investors from the gamblers who try to predict the next move. It acknowledges that the market is driven by liquidity and sentiment feedback loops that are beyond your control. In the end, the disconnect between record-high valuations and collapsing consumer sentiment is a signal of a market driven by specific factors rather than broad-based economic health. It is a time for caution, not capitulation. It is a time to double down on the rules you made for yourself. Do not let the noise of the news feed dictate your financial future. Stick to the automated contributions. Let the math work for you while you focus on your life. This is the essence of Master of Machines. We do not chase trends. We build systems that work regardless of the trends. By ignoring the market noise and sticking to your automated contribution schedule, you ensure that you are participating in the market's growth without exposing yourself to the risks of timing the top or the bottom. The disconnect will resolve eventually. The mean reversion will happen. Your plan ensures you are ready for it. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.